Hello, you all. Welcome back. Greg Silverman, CIOs and Bow Ties, for another series of Come Learn With Me. All the articles that y'all, as they say in Georgia, y'all liked, shared, and we'll go through them together and we will learn together. So come join with me. Continuing our theme of inflation, hedge fund assets near $4 trillion. As fresh inflation fears push investors towards alternatives. Not sure hedge funds or inflation hedges, but okay. Inflation. Growing number of investors are turning to hedge funds to protect their portfolio in the face of inflationary fears. The total industry capital swelling to almost $4 trillion and more allocators set to tilt towards alternative assets, new research shows. Alternative technology provider Vidrio Financial's latest allocator market survey suggests inflation fears during the first half of 2021 are driving further allocations to alternative asset classes such as hedge funds and private equity, which have historically outperformed equities and bonds during times of inflation. The Vidrio Financial Allocator Market Survey quizzed some 4,500 institutional investors globally in late June, collectively representing $100 billion in assets under management and split roughly 60-40 between North America and EMEA. The research found that 1 in 10 investors have significantly adjusted allocations to include more alternatives to protect their portfolio from inflation. Sorry, dog's going mad. Information. While more than 2/3, 70% has made some moderate adjustments, some 20% have not yet made allocation adjustments, plan to do so. Asked about specific strategies, some 44% of respondents said commodity funds would draw the largest allocation. Okay. Yeah. Yes, that would be an inflation. With 33% picking macro hedge funds, okay. And at the same time, 22% said CTAs and tail risk funds would each attract the biggest interest from allocators. All right. Yes, I agree with that. They should be inflation hedges, those strategies. The shifting market environment has proven to be a boon for alternative allocations, said Jigme Gonot, Managing Director, Head of Vidrio Research, noting that a half-year spike in inflation forces is further driving uptick in allocations. Many large institutional investors have made shifts to their portfolios on the margin to counteract potential near-term inflationary issues, with alternatives benefiting, though many allocators were sanguine that even after 40-year bull run in treasuries, any rise in inflation would not have a significant impact on overall portfolio returns. What? The study comes as net inflows into the hedge fund industry appear to be gathering pace, according to separate new research from Barclays Hedge and Hedge Fund Research. New Barclays Hedge data indicates allocators pledged another $36 billion in May, the third consecutive month of net inflows, and a 55% month-on-month rise from the $23.3 billion of allocated capital added in April. Meanwhile, Hedge Fund Research said on Thursday the total hedge fund industry capital has soared to $4 trillion almost at the end of second quarter 2021, up some $360 billion from the start of the year. Industry AUM, which now stands at $3.96 trillion, has mushroomed by more than $1 trillion over the past 5 quarters, since dipping below $3 trillion during the coronavirus turmoil of Q1. Wow, so that's been pretty fast uptick. Uncorrelated macro strategies led net asset inflows in Q2, pulling in some $8.3 billion of allocations as allocators positioned for continued equity, fixed income, currency, and commodity volatility. Recent growth has been driven across broad continual strategies and macroeconomic portfolio scenarios, including balancing economic reopening, reflation trades with sharp reversals in these trends, including risks of additional virus variants, falling interest rates, and possibilities for less robust economic growth over the intermediate term, said HFR President Kenneth Hines. Leading global institutions are continuing to make and expand allocations to hedge funds as an ideal portfolio mechanism. to opportunistically participate in these powerful trends while maintaining tactical flexibility and adjusting to the fluid macroeconomic environment, including the increased influence of retail trading platforms on equity prices and volatility. Okay, I like that. The one question I have, which is not really answered here, is who is the recipient of most of those flows? And I'm going to probably say some of the larger funds, but still, maybe a good time to be launching your macro hedge fund. All right, guys. Oh, excuse me. I'm so sorry. Thank you for joining. Come learn with me. Looks like hedge funds may have their day in the sun yet again. You all take care. We'll speak to you soon. Thank you. Bye-bye.